Welcome back, everybody. Today we're diving deep into a topic that I think a lot of people find intimidating, but it's actually pretty fascinating. The U.S. and Taiwan stock markets.
Yeah.
And specifically, we're going to be looking at how recent political shifts are impacting things, and also the unstoppable rise of AI.
Yeah, definitely a lot going on.
So much. And we've got some really interesting sources today that point to some really intriguing details. Like, did you know that the number 5% could signal a whole market shift? And why is Taiwan's tech industry suddenly like a force to be reckoned with?
Yeah, it's interesting how quickly things can change.
Right,
Yeah.
totally. Well, to help us break it all down, we've got an expert in market trends and analysis who's going to help us make sense of it all.
Well, I don't know about all of it, but hopefully we can shed some light on some of these trends for you today.
Absolutely. All right, so let's jump right in. Our sources mention this thing called the 10-year U.S. Treasury yield,
Oh, yeah.
and apparently it's currently at 4.4%.
Okay.
But there's all this buzz that if it goes above 5%, it's like a bad omen. Honestly, I don't fully grasp what's so special about this number. What is the big deal about 5%?
So it's not really about the number 5% itself. It's more like this yield acts as a thermometer for the whole market.
Okay.
So if it gets too hot, meaning it goes above that 5% threshold, it could signal that the economy is overheating, which can make investors nervous.
Ah, so it's like a measure of how confident investors are.
Exactly. When it goes up, it means investors are demanding a higher return for lending money to the government.
So it's more like a sign of worry than like a direct cause for alarm.
Right. But JP Morgan, they're a huge financial institution. They're predicting that if this yield goes past 5%, it could actually lead to like lower stock valuations and maybe even market corrections.
Whoa. Okay, so it's not something to just ignore.
Not necessarily, no.
So speaking of things that could potentially shift the market, Trump's reelection is a big one, right?
Definitely a lot of unknowns there.
Right. Everyone's wondering what his policies will mean for investors, good and bad.
Well, yeah, there's a lot of speculation. Some are talking about stricter immigration policies, possibly a return to trade protectionism,
Right.
and then there's always the potential for big tax cuts.
Which could boost the market?
Potentially, yeah. But they often come with increased government spending, too. So that could put pressure on the market in other ways.
Okay, so it's kind of like a mixed bag then.
Yeah, exactly. And the thing is, no one knows for sure which policies he'll actually prioritize. It creates a lot of uncertainty.
So what do you think? Do you think his approach will be a lot different this time around?
That's the million-dollar question, isn't it? I think we're just going to have to wait and see what actually unfolds.
Yeah, probably a good idea.
Yeah.
Okay, so let's get a bit more specific. Our sources talk about these key market indices, the Dow Jones, the NASDAQ, and the Philadelphia Semiconductor Index. Each one kind of tells a different story about what's happening. What stands out to you when you look at these indices?
Well, the Dow Jones is interesting. It's been on this upward trend, which on the surface looks pretty optimistic.
Yeah, but I also wonder if it's sustainable. Like, could we see investors cashing in on those gains?
It's definitely possible. The Dow's a good indicator of overall economic health, but it doesn't paint the whole picture. We could see a short-term dip if people start taking profits, but long-term, I think the outlook is still positive.
That's good. What about the NASDAQ?
The NASDAQ, which as you know is heavily weighted towards tech, it's seen some corrections lately.
Makes sense with all the volatility we've been talking about.
But even with those dips, overall sentiment in the tech sector seems pretty strong.
Yeah, it's hard to ignore the potential of AI. I think that's driving a lot of the excitement.
Exactly. And then there's the Philadelphia Semiconductor Index. Now, this one is particularly important for Taiwan.
Right, because they're like a major player in the semiconductor market.
Yes, exactly. This insight is basically a barometer for the global chip industry. So any movements there can signal broader market shifts.
So we should definitely be keeping an eye on that one.
Definitely. Now, speaking of Taiwan, our sources mentioned some recent dips in their market.
Yeah, that got my attention. It seems like foreign investors have been selling off stocks and taking short positions. Should we be worried?
It's understandable that people might be concerned. But I think it's important to note that our sources emphasize these as being driven by non-fundamental factors.
What does that even mean?
It basically means these dips aren't necessarily reflecting problems within the Taiwanese companies themselves.
Okay, so it's not like their businesses are struggling.
Not really.
Yeah.
In fact, Taiwan's tech sector is actually incredibly strong right now, especially with the surge in AI companies like Quanta and Inventec. They're seeing amazing growth.
So they're kind of insulated from all the global anxieties.
It seems that way, yeah. I think the takeaway here is not to overreact to these short-term fluctuations. especially in a market like Taiwan's tech sector, which is so resilient.
Right, so it's more about keeping a long-term perspective.
Exactly.
Now, one more thing about Taiwan. Our source mentions that the Taiwan dollar is weakening, and they link it to these foreign investors selling off their Taiwanese stocks.
Mhm.
So why is that significant? Should we be worried about the weakening currency?
Well, it's all connected, right? When foreign investors sell their stocks, they have to convert their Taiwan dollars back to their own currency. That creates selling pressure, which naturally makes the Taiwan dollar weaker.
Makes sense. But is that a bad thing?
Well, it might seem like it at first, but a weaker currency can actually be good for Taiwanese exporters.
Oh, really? How so?
It makes their products cheaper for buyers using other currencies, so it gives them a competitive edge in the global market.
Wow. I hadn't thought of it that way.
Yeah, it's one of those things that seems counterintuitive, but it can actually be quite beneficial, especially for a tech sector like Taiwan's that relies heavily on exports.
So it's like a silver lining for them.
You could say that.
Yeah,
It just goes to show that there are always multiple perspectives to consider when you're looking at these global market forces.
absolutely. And that there's always something new to learn.
For sure.
This is fascinating stuff. But before we get too carried away, we're going to take a quick break, and then we'll come back and explore some strategies for building a resilient investment portfolio in part 2 of our deep dive.
Sounds good. I'm looking forward to it. So where were we?
Right. We were talking about how Taiwan's tech sector is actually benefiting from the weaker currency.
Exactly. It makes their products more competitive in the global market.
Super interesting. Okay, so now I think it's time to shift gears a bit. We've talked about all these potential risks and opportunities, but how do we actually navigate all of this? How do we build a portfolio that can withstand all this market turbulence?
Right. That's the key question. Well, one of the most important things is diversification.
Diversification, you hear that word all the time, but what does it actually mean in practice?
It basically means not putting all your eggs in one basket.
Okay, that makes sense.
Instead of betting everything on one company or one sector, you spread your investments across different asset classes.
Like stocks, bonds, maybe even real estate.
Exactly. You could also consider things like commodities or even cryptocurrencies, depending on your risk tolerance.
So it's really about tailoring your portfolio to your individual circumstances and goals.
Absolutely. There's no one-size-fits-all approach. It
Mhm.
depends on your risk tolerance, your investment goals, and your time horizon.
Right. So if you're younger and you have more time to recover from losses, you might be more willing to take on some risk.
Exactly. Whereas if you're closer to retirement, you might want to prioritize stability and preservation of capital.
Makes sense. So within the stock portion of a portfolio, are there any sectors that stand out to you as particularly promising right now?
Well, given everything we've talked about with I think the technology sector is definitely one to watch.
Yeah, it seems like those companies involved in AI development, chip manufacturing, all that stuff, they're in a good position.
For sure. They're at the forefront of this technological revolution, and I think investors recognize that.
What about other sectors? I've also heard a lot about healthcare being a potential growth area.
Yeah, healthcare is interesting. The global population is aging. The demand for innovative healthcare solutions is only going to increase. I think there's a lot of potential there.
It's a sector that's driven by a fundamental human need. We all want to live longer, healthier lives.
Exactly. And that's something that's not going to change anytime soon.
Right. So beyond specific sectors, I think it's also important to think about geographic diversification,
Oh, absolutely. You don't want to limit yourself to just one country or region.
especially with all the geopolitical uncertainty we're seeing right now.
Exactly.
Yeah.
So spreading your investments across different parts of the world can help mitigate some of that risk.
And of course, we've talked a lot about Taiwan. It seems like a pretty compelling opportunity for investors looking to diversify geographically.
I think so, yeah. They've got a strong tech sector. They're a key player in the global supply chain, and they seem to be weathering these global storms pretty well.
Okay, so let's circle back to bonds for a moment. You mentioned earlier that bonds are traditionally seen as a hedge against economic downturns.
Mhm.
Can you explain that a bit more? What makes them so attractive during times of volatility?
Well, bonds offer a level of stability that you just don't get with stocks. When the stock market takes a hit, investors often flee to the safety of bonds, which drives up bond prices.
So it's like a counterbalance to the ups and downs of the stock market.
Exactly. That negative correlation between stocks and bonds can really help to smooth out the ride during turbulent times.
But we did talk about the fact that the current bond market is a bit tricky, with those rising yields potentially eroding bond values.
Right, that's a good point. It's not as simple as just buying bonds and forgetting about them.
Yeah.
You need to be more strategic,
Okay.
especially in this environment.
So how do you navigate that?
Well, that's where those bond ETFs we talked about earlier can be really helpful.
Oh, yeah. Those are becoming super popular in Taiwan.
They are, and for good reason. They offer a convenient and cost-effective way to diversify your bond holdings.
So instead of putting all your money into one bond, you can spread it across a whole basket of bonds.
Exactly.
Hmm.
And that can help mitigate some of the risk associated with rising interest rates.
So it makes sense. So bond ETFs sound like a pretty good option for investors who are looking for a bit more stability in their portfolio.
I think so, yeah. They're definitely worth considering. But as with any investment, it's important to do your research and make sure they align with your individual goals and risk tolerance.
Absolutely. All right, so we've talked about diversification across different asset classes, different sectors, different geographic regions. We've even touched on the importance of understanding the bond market. But there's one more piece of the puzzle that I want to explore.
And what's that?
AI. It seems like AI is poised to disrupt virtually every industry, and the world of investing is no exception.
Oh, absolutely. AI is already changing the game in so many ways. From data analysis to portfolio management, it's really quite fascinating.
Well, that's a perfect segue into the final part of our deep dive, because in part 3, we're going to explore the fascinating world of AI and how this transformative technology is shaping the future of investing.
I'm looking forward to it.
Welcome back to our deep dive, everybody. We're here in the final part now, where we're going to be digging into this whole AI thing.
Yeah, this is where it gets really interesting.
Right, like AI is this revolutionary technology that's changing everything, and the world of investing is definitely not immune to that.
Absolutely not. It's already disrupting traditional approaches and creating a ton of new opportunities.
So much potential. So I'm curious, what aspects of this AI revolution in investing are you most excited about?
Well, for me, one of the biggest impacts is in data analysis.
Okay. Yeah, that makes sense.
Like AI algorithms can process huge amounts of data and find patterns that humans would just never see.
It's like having a super-powered research assistant working 24/7.
Right. And this gives investors a massive advantage because they can make much more informed decisions.
So AI is not just about replacing human jobs. It's also about giving humans better tools.
Exactly. And actually, AI is already starting to automate a lot of tasks that used to be done by humans.
Like what kind of tasks?
Well, things like portfolio rebalancing and risk management. Stuff that can be pretty time-consuming and prone to human error.
So it's like having an AI co-pilot helping you navigate the market?
Yeah, I like that analogy. And this leads to another exciting development, which is personalized investment advice powered by AI.
Wait, what's that?
So imagine platforms that can analyze your financial goals and your risk tolerance, and then create a custom portfolio just for you.
Wow, that sounds amazing.
It is. It's like having a personal AI financial advisor.
Available 24/7.
Exactly. And these platforms are getting smarter all the time, thanks to machine learning. They can learn from your behavior and refine their recommendations.
It's like AI is democratizing access to sophisticated investing tools that used to be only for the super rich.
I think so, yeah. It's leveling the playing field.
But here's a question. With all this AI taking over, is there a risk that human intuition and judgment will become obsolete?
That's a great question, and it's something a lot of people are worried about. But I think it's important to remember that AI is a tool. It's not a replacement for human insight.
So it's not like AI is going to make all the decisions for us.
Right. We still need human judgment, especially for those big picture decisions.
It's about finding the right balance.
Exactly.
Wow.
We need to leverage the power of AI, but also maintain that human element.
I like that. So as we wrap up this deep dive, what's the one key message you'd like our listeners to take away?
I think it's to embrace the change and stay curious. The world of investing is constantly evolving, especially with AI. So you got to stay informed, be willing to adapt, and always be learning.
Love that. A huge thank you to our expert for sharing all these insights.
My pleasure.
And to you, our listeners. Thank you for joining us on this deep dive into the U.S. and Taiwan markets. Remember, knowledge is power, especially when it comes to investing. So stay curious, stay informed, and until next time, happy investing.